QuickBooks Pro Desktop 2021 Make Loan Payment. Putting together amortization table for a loan, using that amortization table to record loan payments, breaking out the payments between interest and reduction of principal. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown and selecting the open windows list. We're going to be entering payments related to a loan now. So to do that, to consider that, let's pull out our financial statements by going to the reports dropdown. Company and financial, we'll be taking a look at the balance sheet standard. Changing the dates up top in the customized reports from 01/01/21 to 12/31/21, January to December 2021. And okay, so we're going to be making payments. That means the checking account is going to be going down. We'll be paying down the loan down here where we have the loan payable. It's a little bit tricky, however, when you pay down the loan. So we're going to have an installment loan that we will be talking about. And that's kind of like the typical kind of process or loan that you would have if you had a home loan or a car loan or equipment loan that you're paying off monthly. The major component or the major thing that's thought about when you're thinking about a loan that you pay off monthly is the amount of the monthly payment. That's the thing you're trying to keep fixed, keep standard from each month to each month so that you can, see if you have the money to pay the payment. But since you're paying interest and principal over the time period of the loan, that means the interest and principal will change. So if I double click on this loan payable, note that we have two items in here. I'm going to change the date to 2020 for the beginning so we can see the two items. We're going to assume here that these two loans are basically been combined. They've been financed together. We have one loan at this point in time of the $72,000, just to get a feel for the creation of basically an amortization table, helping us to break out the interest and principal. Now note when you have your loan payments, basically the thing you'll negotiate is you'll get down to your payments, and you might know the interest and the number of payments, of course, but it's going to change each payment that you have, the allocation between interest and principal. So that's going to be the problem that you got to deal with. To figure that out, you typically need to put an amortization schedule together. The loan company might give you one, but they may not, right? They may not give you an amortization schedule. Then you might want to talk to your accountant to ask them to give you an amortization schedule. Or there's a couple other ways that you can basically work with your accountant to make this as easy as possible. So the bottom line here is that when we write a check for the loan payment, we're going to have part of it decreasing the loan, part of it going to interest, which is going to be like the rent on the loan. And that means that there's going to be two accounts, two expense accounts, instead of just one when we write the check. That can be a little bit confusing. Not only that, but those two accounts will be changing each time. So one way you could deal with that is to work with your accounting firm basically to make the adjusting entries at the end of the month or the end of the year. And you might just tell them, hey, look, I'm just going to write the checks and write it to the loan payment here. I'm not going to break out the interest of it. I want you to then create the amortization table and then adjust it at the end of the year or the end of the month to the proper interest amount. That's kind of like the easiest thing to do, and it's a nice separation of duties between the bookkeeping data entry process and the adjusting process, and that can make it so the bookkeeping is really easier, so you don't have to change the loan payment or record two accounts, and then the adjusting department can just basically adjust it periodically as needed at the end of the month or at the end of the year. Or you can ask the accountant to make an amortization schedule for you and then basically break out your payments in accordance with the amortization schedule. Or of course you can make your own amortization schedule, which we will do here. So let's take a look at it. We're going to say, let's just put together an amortization schedule just based on this data, basic kind of amortization schedule to get a feel for it. So let's say we have a loan of the $72,000. We're going to assume the loan is starting at this point in time. The first payment's going to be made on the loan here. So we're going to start at 0 and pay up from this point forward. So we refinanced it at this point in time, and we got the $72,000 loan. We're going to say it's a 60-month loan. Now, when you say 60-month loan, I mean, if you take 60 divided by 12, you're talking about a 5-year loan. So they might just say 5-year loan, monthly payments. That means 5 times 12. That means 60 payments that you're going to have on it. So 60 payment, 5-year. We're going to say the rate is 5%, and then the payment amount is usually what will be given to you by the loan processor. But I just want to recognize the fact that we could calculate this payment right here using the Excel formatting here And by doing that, we could back into any other item that we need as well. So let me just show you that here. We're going to go to the Formula tab up top. We're going to go to the Insert function, and I'm looking for payment. So I'm going to say payment that we would have. It's actually the PMT. Let's just type in the payment. This is the formula. The payment formula calculates the payments for loan based on constant payments. So I'll use the little format box here to do this. This is the formula box. Gives you a little bit more detail and description. So I'm going to say OK. So as we do this, you'll see this thing being populated to the left. You could just simply type it in on the left-hand side, or you can use this formula box. I'm going to say the rate is going to be this 5%. Now remember, that rate is for a year. We want to do this monthly. So the trick is I got to take that amount and divide it by 12. Anytime you see a rate on a loan, remember that that typically is the yearly rate, even if you make monthly payments. And therefore, you will have to break it down to a monthly rate if you're talking about a monthly payment scenario. We have the number of periods, which is going to be 60 periods. And then the present value, or the PV, the loan amount, is going to be that 72. So there we have it. That's going to be our information. I'm going to say OK. And there we have it. Now this is rounded, so I'm going to go to the Home tab. You could add decimals, and those would be the pennies on it. I'm going to double click here, and I want to flip the sign to a positive number. I'm going to double click on it, put a negative before the P to flip the sign, making it a positive. So there we have that. Also note, if you double click on it, you could data input it with this little bar down here, the rate 5% divided by 12. Number of periods is in B2, 60, and then the present value is the 72. This may be the basic information you have, and when you break out your payments, you might say, okay, that's easy. I'm going to decrease cash by this amount and record the other side to the principal. But then you got this interest you have to deal with, and the interest will vary. So let's break this out into a table. Now we'll make our table. So I'm going to say this is the payment number, and then I'm going to say this is the payment amount. And then I'll say this is the principal reduction, and this is going to be the principal remaining. Principal remaining. Did I spell all that correctly? Possibly. Totally did. Of course I did. I knew I did. So then I'm going to go to the Home tab, alignment, center this, and we can put like boxes around it if we so choose, or you might want to make this. I sometimes make it a different color, like black and white. So and then I'm going to list our payments. I'm going to start at 0 and then 1, and then I'm going to center these items. Home tab, alignment, center. I'm going to use the autofill to auto it down to 60 payments. So I'm going to autofill it. I can see the little number popping up down to 60 payments here. So we have 60 payments. And then I'm going to say we're starting at the principal of 72,000. So when we make the first payment, how should we be breaking out the principal and interest? And I'm missing a column. I'm missing the interest column. I need an interest column right here. So I'm going to select this whole C column, right click in there and say insert please, and we need interest. All right, that's what we have. Okay, so then we're going to say the payments are going to be equal to this amount. So that's going to be the payment amount. I'm going to add decimals to this whole thing. I'm going to scroll all the way down and add some decimals here. I'm going to pull that over. And let's add a couple decimals. Home tab, numbers, add a couple decimals. I know I'm doing this quick, but I just want to show you it. This isn't really an Excel course. So the principal is going to start out at the 72. So if you don't do this in Excel, that's okay. We'll just use this to make the payments in QuickBooks. So this might be something you get from the accountant. So then we're going to say, then the payment is that. How much is the principal? It's going to be equal to the 72,000 times 5%. That would be for a year, however, and this is for 1 month. So I'm going to take that and divide it by 12. And so we got the 300. So that means if we pay this much, 300 of it is basically the rent on the purchasing power, or what we call interest, of course. So the payment minus that 300, that's going to be what the reduction in the principal amount is. So then what's our new principal amount? It's going to be the 72,000 minus the 1,058.73. And that'll give us our new principal. Now the payments are always going to be the same. So I'm going to say this is the same payment. The interest will now change, however, which is the cost of us keeping the payment the same, because now it's going to be the new principal amount times the 5%, but that would be for a year, divided by 12. So now we have a little bit less interest, and now I'm going to subtract this out. That's the reduction in the principal, and now we have the prior principal minus the reduction in the principal. That's where we stand now. Let's do it one more time. So this is going to be equaling the prior payment. Interest calculation equals the principal times the interest rate divided by 12. So that means the principal reduction is going to be the payment minus the interest. New principal is going to be the principal minus the principal reduction. Now I would like to copy this whole thing down using an autofill feature, so I'm just going to try to copy that whole thing down. Let's do it one time. There will be a problem, and then we will fix it. So I'm going to copy it down. This did what we wanted it to. That looks good. This one didn't. This cell is right. That cell is wrong. It should be the 5%. So I want that to be an absolute reference, that 5%. I want to tell it, don't move that down when I copy it down, please. And so I'm going to undo that, double click here. That's cell B3. So B3, I want to make an absolute reference telling Excel, do not move it down by selecting F4, putting a $ before the B and the 3, and then enter. So this one should be okay. This one should be okay. So I think I'm good. I'm going to highlight all of these. I'm going to autofill it all the way down, putting my cursor on the fill handle, dragging all the way down to 60 payments down here. And then once I get at the bottom, if I did this right, I should have a 0 at the end of the day. So it should go down to 0. So that's our indication that we have our amortization table set up properly. So there it is, and you can see then what the complication is. We're making the same payment, but we have to apply it to 2 accounts, and then we can't even memorize the 2 account amounts, however, because the amount related to interest and principal will change every payment we make. We're going to record the first 2 payments just so you can see it. We're going to record it at the beginning of the month, and then like jump to the end of the month and record the second payment, in the same month, but as if it's the end of the month, just so you can see how that change happens and kind of the problem that you have in QuickBooks and how to save that, how to deal with that problem. So I'm going to highlight this one. I'm going to make this green here. I'm going to put brackets around this I'm going to highlight this whole thing. Add one more thing. I'll make it look a little nicer. I want to make it look nicer. I'm going to go to the Home tab, Font Group, and put boxes around it there. Okay, so now we're going to do it. We're going to go back to QuickBooks here. I'm going to write a check. So I'm going to close the detail for now. We're going to go to the home page. We could do this in the check register, or we can simply write another check. So you can open the check down here, or you can go up top and you can open the checks here. So once again, the check means a decrease in the checking account. It may be something other than a check. You might pay it in some other way, shape, or form. But if you pay it with a check, you have the check number. If you do not, then you'd use some other indication there. We're going to be paying this as of January or February 1st, the first month of the first day of the second month. And we're going to be paying it to, we're going to say Chase is who we got, is our bank that we got the loan from. We already have Chase in there because we did something else with Chase prior to this. I think it was the loan. We got the loan in any case. So then we're going to say the amount that we're going to pay is going to be the 1358.73. So we're going to say, all right, this is 1358.73. And then down here on the, and then you could say this is like, maybe you want to say first payment down here. And then the account, we can't just have one account down here. We're going to need 2 because now we're going to have to break out both the principal portion and the interest. Interest 300 and principal reduction being this amount, leaving us with the principal at this amount that's still on the books. Now again, there's a problem there because if we do that, notice that we would like QuickBooks to memorize the transactions so that next time when I record it, it'll basically memorize the same thing and I'll be good to go and just be able to move forward. Now, the fact that we have 2 accounts complicates that a little bit, and the fact that those 2 accounts will change complicates it a little bit more. So if you want to make this as easy as possible, you could just put this whole amount to basically the reduction of the principal, right? If I put this whole amount to the loan payable for the full amount, then I'm not recording the interest. And then I can tell my bookkeeper basically at the end of the time period to just, my accounting firm or CPA firm, when I do my taxes or adjusting entries at the end of the month, to make the adjustment, recording and adjusting entry, breaking out the interest. That could be a really good separation of duties if you have a CPA firm or accounting firm that wants to help you in that format. Or you can break out basically the interest with the amortization table here as we go, of course. So I'm going to say then the principal portion is going to be the 105,873. So this is going to be the 1058.73. And then we could say this is the first payment. And then we're not going to have a job or billable. And then the second component is going to be interest. We haven't recorded the interest yet. Let's see if QuickBooks has an interest expense amount. It does. So there's the interest expense. And it's already picking up the 300 first payment. It's already picking up the 300 because it's calculating this amount, 135,873 minus the payment amount. That's how much we need to basically be in balance. So there's going to be the two amounts. What's going to happen when we record this? Checking account's going to go down by the full check amount. The loan's going to go down by the principal by that amount to match this amount that's going to be on our amortization table. And then we're going to have the interest expense on the income statement of the $300. Let's check it out. Save and close. We're going to go to the balance sheet up top and we'll say, all right, that means the checking account went down by that 135,830.73. Double clicking on that, we see our check. Closing this back out. The second half of that, or another component of that, is going to the loan. And the loan's going down by the 505,873. That leaves us with the 70,941.27, which should match this amount, 70,941.27. It does. That's good. Closing this back out. Then the other side's on the P&L, reports drop down, company and financial, profit and loss. Changing the dates up top from 01/01/21 to 12/31/21. We then see our interest expense up top. Double clicking on that interest expense, we see the detail within it going back to that payment that we have just made. Closing this back out. Let's do it another time now. Now we're going to imagine we're jumping forward to the end of the month. And we're going to record the second one. I'm going to record it at the end of the same month, but it might be in practice in the second month, but we just want to record two of them just to show this kind of problem with this breakout between the interest and principal. So I'm going to go back on over and I'm going to go to the home tab again and say, let's write another check now. I'm going to say banking. Let's write another check. And I'm going to write it's coming out of the checking account. I'll keep the check number there, but this time I'm going to say it's at the end of the month, so I'll say it's at the 28th of this month, so 28, and it's going to go to Chase. Now watch what happens when I put in Chase, and I don't think anything's going to happen because we have those two accounts down below. So if I hit enter here, we see that no activity. Now just to test this out, I want to take a look at the preferences. If I was to adjust this and put in Verizon, we're not going to record anything to Verizon, but I just want to type in Verizon. Now we entered a check to Verizon last time. Let's see if anything populates down here in the expenses. I'm going to say tab. We have the telephone expense. So it gives us the expense amount, but not the prior amount that was in the telephone expense the last time we had it. Let's close this out and then take a look at the preferences real quick. I'm going to close this out just to test out the preferences. I'm not going to record it. There's nothing to record. And then I'm going to go to the edit dropdown, preferences, and review these general preferences we had, and you'll see this automatically recall information. We had the pre-fill account for vendor based on past entries. Let's try this one, automatically recall last transaction for this name, and then let's try it again. And so I'm going to go, let's see the difference. Okay. We will make that change, and then let's go back into our check. We're going to go to the banking dropdown, write checks, and then this time I'm going to write it to Chase again. So I'm going to say this is as of the end of the month, so this is going to be February 28th. So February 28th, and this is going to be Chase, and then I'm going to say tab, and now it populated. Notice it populated the full amount this time. So this could be useful because, again, it picks up the two line items this way where the last one didn't. It could be a little bit confusing because the amount may change. So you may want to toggle between those two options, see what is best for you. But this one works pretty nice because it pulls up the prior transaction and then you have to adjust the amounts in it as opposed to simply pulling up the account number. Either way, you can see that QuickBooks will start to memorize the transaction. Now, when I look at this amount is right, but when I go down here to the expense side, this amount is now wrong because there's a difference between this breakout. It should now be principal portion 106314. So this should be 1063.14 now. And the interest then we need to change to match this item, which is 295.59. So this is 295.59. So you can see that's still a bit burdensome, even though it memorized the transaction. If you have somebody else recording this, just doing the data input, possibly taking this information, from a bank statement or something like that, they may not properly adjust these. And if you're doing this from bank feeds, then it's going to be difficult to break out these two items to the proper accounts. And therefore, you might want to do some kind of adjusting entry process, doing, like we said, posting it all to the loan, and then having an adjusting entry process by the accountant or tax preparer, breaking out the interest in accordance with the amortization table periodically. So, but in any case, we're tying this out to the amortization table. What's this going to do? Decrease the checking account by the amount of the check. Decrease the loan by this amount. That will leave us with a loan balance of this amount, $69,878.13. And then we have the interest expense that will be recorded on the income statement here as well. So we're going to say save and close and check that out. It's reminding us that we could buy checks right now. So I'm going to say, no, I don't want to buy checks. I think that's what it said. I didn't read it too carefully, but I'm pretty sure that's a little pop-up advertisement trying to remind us that you could buy checks from Intuit, or, for QuickBooks at least. So then we're going to go back to the balance sheet and to see what happens. If I go up to the checking account, we're going to say, all right, here's the second one. It looks exactly the same as the first one, but in terms of the payment, because the same amount came out of the checking account, but it got applied differently to the other two accounts. So if we then go to the loan payable, double-clicking the loan payable, you can see the amount differs here that got applied even though the same amount came out of the checking account. We're now at the end result of the loan, $69,878.13. That should tie out here, $69,878.13, to our amortization table. That's how we can double check that we did it properly. Closing this back out, then we can go to our P&L, the profit and loss, and there is our interest expense. Double clicking on that, we'll see our interest is now different. Interest amount should be lower with each payment if we have our standard kind of installment process. So closing this back out, there it is. Let's go back to the balance sheet. If you're following along with us, these are our balance sheet numbers as of this point in time, so you can check those numbers. If you want to check your income statement, here is our income statement as of now. I think the easiest way to check is on the trial balance, so let's open that up. Go into the reports, accounting and taxes, trial balance, dates from 01/01/21 to 12/31/21, and there is our trial balance.